Hi, this is Grant of Fortuity Risk Analytics. So today we're going to take a look at gold versus bonds. So in the green line here, we have gold, which is the GLD ETF, versus bonds, the 20-year Treasury ETF via the TLT. So as you can see over the last year, the correlation has been almost 1. And so if you have a view on gold, you must have a view on rates. Essentially what's happening with quantitative easing from around the world, we've seen a lot of money flow into gold as well as treasury, so essentially that reach for yield. So this chart we're looking at the US 10-year. As you can see back in July, US 10-year hit about 1.36%, and since that time we sold off. We're sitting at about 1.8% now. So what's happened is when there's about $20 trillion of negative interest rates, it was pushing yields down, and now we're sitting at about $18 trillion of negative interest rates, which has pushed yields up. So here we have a long-term chart of speculative long positions in gold dating back to 95. So what you can see in this peak in July, spec positions were at all-time high. This had a lot to do with quantitative easing and central bank lunacy. So at the end of the day, if you're trying to protect your portfolio with gold, you also have to have a view on interest rates. If you think interest rates are going up, that means you think gold's headed down, vice versa. This has been Grant of Fortuity Risk Analytics.